Hey everybody, Marty Missouri here, Friday, September 8th, 2023 with your weekly economic update. We're going to do that quickly, then we're going to do a quick technical analysis, or let's just say take a quick technical look at the S&P 500 and the NASDAQ 100 tracking ETF. Then I want to touch on oil and talk about inflation. I want to talk about how small cap stocks have been faring versus the broader market, what that says about conditions. I'm going to talk about breadth, a little bit about sentiment, and going to finish up with the dollar. So I think this will be a very instructional, I think, somewhat telling presentation about current conditions and what odds lean to going forward. So we'll start though with the economic look, which according to our index is now back to deteriorating. We were down a couple of points on the week to a negative 21, suggesting that odds favor recession over continued expansion in the coming months. We'll keep a very close eye on that, as we always do, and continue to report to you accordingly. So just a small number of inputs I want to touch on today. First one is auto sales. Those came out this week, and you can see that they look like they may be rolling back over. Probably makes sense relative to what we're seeing in overall conditions, reflection of what we're seeing in some of the consumer data, which suggests that on a 6-month outlook, folks are really planning on cutting back their spending on all things big ticket, whether they're cars, appliances, homes, you name it. Sentiment in terms of consumer activity going forward seems to be shifting from a lot of spending on discretionary and big ticket items to pretty much focusing spending on the essentials. That, of course, is part and parcel to late cycle recessionary conditions, which still remain our base case. The mortgage purchase apps speak to that as well. We are like at 1995 lows. You hear from some folks that the residential space is still pretty hot. It's not. Clearly it's not. When you look at mortgage purchase applications, what you have, and this is no news to any of you, I'm sure you've heard it from everybody and from me as well, that when folks are sitting on sub 4% mortgages, which is most people these days, even if they want to sell, if they need to mortgage their new place, they're not going to at what was, I think, last I saw, 7.6% average 30-year fixed mortgage rate. Home builders, have been having a pretty good go of it. Stocks are still more elevated than I think they deserve to be. And when you look under the hood, they're buying down these mortgage rates. I've seen buy downs to like 5.5%, which sounds attractive right now. Giving lots of incentives to get those homes sold. The housing index, which is essentially a home builder confidence index, is now right on the borderline between expansion and contraction. So even the home builders aren't that optimistic right now, despite what have been pretty rosy earnings reports for the last quarter from the likes of, say, D.R. Horton. Now, what really flew in the face of those of us who think the economy is weakening is this week's ISM Services survey, which shot up to 54.5 from 52 something. The consensus estimate that it would be down here on the 50 line, which is the dividing line between expansionary and contractionary sentiment. We talked about some less pessimism maybe in the manufacturing space. Interestingly, and I wrote about this already, so we won't belabor it here, the market sold off heavily on that news this week, and I essentially just reiterated the point that right now good news is bad news, because when things like the ISM survey read optimistic, and probably more importantly, the prices paid component popped higher, well then that doesn't really give the Fed much ammunition to lower rates anytime soon. Next week we get the CPI number, and that's why I wanted to talk about oil here toward the end. The Kansas City Fed labor market conditions index, that's one that we added this year to our core index, our economic or our general conditions index. And you can see that one's rolling over. We added it because it's been a good indicator heading into the last few recessions. So you can see the shape of that line before the tech bubble burst, before the residential real estate bubble burst. We were topping out before the COVID recession, and here we are rolling over pretty hard. So obviously that's a negative input to our index. The global PMI, it's kind of a consolidation of PMIs that JP Morgan puts together. And again, 50 is the dividing line between recession and contraction, and rolling over pretty hard, which again doesn't speak well of prospects right now within the global economy. The data continues to be concerning, not remotely early cycle stuff, as some people I sometimes am surprised to hear are trying to suggest that we're at the beginning of a new upcycle. And I just scored our equity market conditions index, a lot of cyclical stuff in there, and the vast majority of it looks late cycle, not early cycle. So in terms of the technicals, just really quick, remember we looked at this in here. Sorry for how busy this is. I've tried to ghost a lot of this, still looks terribly busy. But we had this uptrend line off the March low, got tested and failed that. Back just below the 50-day moving average. That 20-day moving average has been real important, and we're trying to lose that again here on the S&P. I told you that even if we reached into a marginal new high, there's no way the momentum indicators could catch up to that, and that would be a bearish look. So right now, market looks like it wants to roll over. It was up pretty nicely earlier today. I'm looking across now. The NASDAQ 100 is down 6 basis points. S&P is down 1. We could get a big thrust. Could be that options dealers are positioned to pin this thing back up to higher levels by the end of the day. We'll see. But right now, it's interesting that today's little rally off of what's been a pretty weak week is getting sold into, at least at 12:05 p.m. Pacific Daylight Time. So 55 minutes left to go in the session. As for the NASDAQ 100 ETF, same thing, although still did bounce off of that 20-day moving average. That would be short-term positive, bumping up against this trend line from the January of this year low. So we'll see how this shakes out. This one I said as well. There's just no way the damage on the momentum indicators can be repaired this go round. Doesn't mean we couldn't meander higher and then this stuff all shake itself out without some big collapse. But we just do think there's notable downside risk here. And we think the charts are confirming that risk, not outcomes. We don't know what the outcome is going to be. All we can continue to do every day is assess the risk reward setup. So let's just take a look at oil. I just pulled up this chart and just wanted to make this one very clear and very simple. Lots of bullishness from economists and analysts who I have a great deal of respect for, even some who we pay a not small amount of money to each year for all of their analysis, including their commodity research. And pretty bullish on oil for the most part. I did hear an interesting bear case recently from a legitimate analyst that I thought was also, worth considering. But for the most part, the people who usually get these things right are pretty bullish. OPEC has extended production cuts and seems to be committed to keeping a floor under the price. Who knows? Maybe that floor is $85 at this point. When I look at it technically, however, what I see is a real classic rising wedge pattern with bearish divergences on the momentum indicator, a buy signal on the MACD that's looking to roll over, and overbought on the RSI. So while the bulls may absolutely have it right, technically this thing is ripe to roll over and give back some of those recent gains. Again, lots of fundamental support underneath it, other than, I should say, our overall economic view. But when you look at supply dynamics, and that's what this is, the yellow line is WTI, or West Texas Intermediate crude, inventories in Cushing, Oklahoma, and then the orange line are actual U.S. rig counts. And you'd think with oil prices really coming back that you'd see a lot of this production coming back online. Well, we're not seeing that, right? So these two factors right here would be very bullish. And folks, our long-term thesis beyond what we believe will be a recession, or we think odds favor that, beyond that, and I want to make very clear that that's what I'm talking about, that I think we need to remain relatively cautious until this thing finishes playing out. Beyond that, we expect to be structurally bullish on many commodities, and the energy space is going to be in there as well, and this supports that. What I'm just saying is right now, this thing could break down and surprise a lot of people, and a lot of people are long oil, so that you could have a lot of people, selling that. And that would be good news for CPI. Now, speaking of CPI, of course, the headline number is heavily influenced by the price of oil and gasoline. And you can see what's been going on here. So I'm thinking there's a pretty good chance that next week's CPI number is something that comes in relatively hot. If it does, stocks probably aren't going to like it. So, of course, we'll be talking about that next week when we get there. Small cap stocks, Russell 2000 index is the green line, S&P 500 here in the top panel, the white line. Going back to before the tech bubble, we look at this every week, plus another 100 indicators at least probably. But this one's kind of popping out there at me right now. And we're not just looking for the bear stuff. I'll tell you gladly when I see bullish stuff as well. It's just that the scales are kind of turning to the bearish or the concerning side, if you will. Certainly not to early cycle stuff, as I just said. So here's small caps rolling over while S&P is still marching higher until it wasn't. Here's small cap rolling over, same scenario. Here's small cap rolling over. That was actually about a 20% dip right there, almost 20. Here we were before that 16% dip, and they covered across some of 2015 and 16. Here we are, essentially flat right before this, around COVID. Here we were, didn't draw a line here. Here we were pretty flat right in there, I guess. We did peak up above that while the market was marching higher before we rolled over into last year's bear market. Same kind of scenario right here. Again, absolutely unequivocally doesn't mean that things can change and small caps can get wind in their sails and catch up and blow this indicator out of the water. Right now, it's a red flag. Breadth, the S&P 500 equal weight index, the green versus the S&P 500, the white. Remember, you take out 7 stocks and you don't get much out of the S&P this year. That's reflected here. It's cap weighted, very concentrated. This would be giving, every stock its due. So, if there's actually 504, so, 504th weighting to each company, and, most stocks are down. So down 3% over the last 30 days versus just slightly down for the S&P. Make no mistake, this is not the hallmark of a healthy stock market. So the S&P is just below its 50-day moving average. Well, 67% of its constituents are below their 50-day moving average. Remember this? We were pointing to this right in here before this began to roll over. 200-day moving average, there's still a pretty massive gap between the S&P price and the 200-day moving average. Almost half of the stocks in the S&P are trading below their 200-day moving average, 52% above. Again, does not comport with the price of the index, talks about the concentration. Doesn't mean that we couldn't get a broadening out and this catches up, just means that this is the kind of stuff that tends to happen before the market tends to roll over. In terms of breadth, probably the one that is the most telling or the most concerning is the NASDAQ Composite Advanced Decline line. I mean, we've obviously been looking at breadth for a long time. It's been a really important indicator for us over the years. It got us really bullish 6 months before the market broke out of that 2014 to 2016 malaise. And I was doing videos and showing it to you then. This isn't a good look, folks. This is just massive breakdown in breadth for the NASDAQ, which is big, right, in terms of its influence on the S&P 500, if you will, or the components influence. And here's the price continuing to march up. Well, here's the price breaking down below this trend line. So we'll see if that continues to play out that way. Investor sentiment. The green line is the American Association of Individual Investors. Bulls, over the next 6 months, the red line is the bears. At the market all-time high before it rolled over. They were crazy bullish. I did this for you, recently, and and shaded it there to show you that they haven't been as bullish since then, right? And leading up to that, I drew these circles either where they crossed over, where bullishness became more than bearishness, if you will, or got close. And I think there were 9 times, and 6 of those 9 times it was right before the market rolled over. Here was a question mark, I think, when we did that. Market actually didn't roll over on that. It continued to move higher, but then it moved into a position that was as toppy as it was back here. And then you could see that investors indeed reacted to this August downdraft. And we got a little updraft, and here we go again. So contrarianly speaking, not a good look for equities right here. And then last but not least, and maybe most importantly, is our dollar index. In our equity market conditions index coming into August, the dollar was a negative weight on our conditions because we were technically bullish the dollar, and sure enough, that played out, and stocks had a rough August. And then, as I wrote and shared this part with you here, I think at the beginning of this week, we went neutral, the dollar, for September, but I said it was tempting to stay bullish because we had this bullish engulfing candle on the last day of August, and that's a very bullish look. Sure enough, over this next week, look what we got. We got a really strong dollar, and we've had a really weak stock market. So yeah, the negative correlation between the dollar and stocks is still on. Now, when I draw my lines, what I would essentially do is point to right here what is unequivocally, right? I can just pull this one over, a rising wedge pattern, right? But we don't have the bearish divergences that would have us bearish the dollar, which would give us a bullish signal for stocks, only relative to its correlation to the dollar. The reason we didn't go bullish like we were tempted to, right now it looks like we'd sounded a lot smarter if we did, at least for the first week or so, is that at the time our momentum indicators were not substantiating that call. Right now they actually are. So we have a new high on the MACD along with a new high here, recent new high for the dollar. However, we are really overbought on the RSI. So go back here and just follow my arrow. Here we are now. Here we are just about there. Boom, dollar lower, right? Here we are. Boom, dollar a lot lower. Here we are. Boom, dollar lower. So we're there as well. So while we've got this bullish candle pattern, this momentum in the price, we do have it showing up here. Pretty darn overbought against a rising wedge. So the headwind that the dollar is producing for stocks right here may fall off and give some support for the stock market. I mean, lots of other factors are influencing it. Having said all that, as I said earlier, CPI could come in hot next week. You could have the Fed. I don't think they'll give you a rate increase 2 weeks from now, but they could sound real hawkish. That would probably be bullish the dollar. And it will be until markets in general believe that the Fed is on the cusp of creating a accelerated slowdown. And that's ultimately where we think odds favor, but the market doesn't believe that just yet. So I think you get the general gist of what we think about conditions, what we think about risk going forward. I do want to reiterate, as I did the other day on the written blog, we are long-term bulls on a lot of things once we get through what's left in the current cycle. So what we're doing is we're hedging portfolios, we're staying very diversified, more cash than we normally keep. We're using short-term treasuries for that moment to protect or mitigate some of the downside as much as we can and be in a position to take advantage of it if and when it comes. Folks, thank you as always for watching and listening. Hope you have a wonderful weekend, and I'll talk to you again next week. Take care. Bye-bye.